Hi, this is Zach Meir with the Bulletin Board Heroes here at Vox Markets for Friday, the 1st of July. Starting off with the FTSE 100, where we're trading in the wake of the bull trap through the 200-day moving average, which we had earlier this week. Managed to fail to get up to the 50-day line. That's currently around 73.77, which is obviously disappointing. Also had an RSI failure just around the neutral 50 level, which tends to be a bear signal. Obviously, that's worked so far. Most likely scenario now is that we head towards the main support line here. That's one that's been in place since the early part of 2020. So the whole market resting on the 70.30 to 70.40 area, and that is where likely support will come in. If it holds, then obviously we could then gyrate back to the 200-day line, 73.50. Otherwise, there's the risk of a retest of March support down there at 6,800. But at the moment, still just about favouring the idea of that big support line there from a couple of years back will remain in place. We'll just go look and have a look at that now. That's the major line there, so odds normally favouring such a major support line to hold, but obviously we're not in a great situation in terms of sentiment or anything else at the moment for the market. Speaking of sentiment, still not very good in terms of the crypto space. People sort of going for the "I told you so" type of thing here, with the Bitcoin near 20,000. Slightly better than yesterday, i.e. we're in a kind of range here between 19 and 22,000, rather than breaking down to the floor of that channel from March, which is predicting, let's say, a move as low as 15,000 at the support line projection there. That could be seen by the end of this month, but we'd have to see sustained price action back below 19. So far, we're kind of avoiding that. We were oversold earlier in June, but at the moment we're just resting along or around the oversold level, so that may explain why this market hasn't tumbled any further or faster in the meantime. Be looking for a momentum trigger, positive one, then it would be an end of day or weekly close back above 22,000 to give us a potential move back up to the old May support near 25,000. So it's basically 25, 22, 19 and 15, the key levels there. Onto the stocks, and obviously not too many of them at the moment as far as the hero status is concerned. Arrow still looking good though. We've had the retest of that support there from back in May. Unfilled gap to the upside just towards the end of last month, and that tends to be a very strong signal, especially when there's a bear trap effect there. But we had a gap fill rebound and then a bear trap rebound and a bear trap gap reversal. So that's all looking pretty healthy. 50-day moving average still rising. We're trading either side of that. And the view now is that, especially while we're above 15.5 pence, we should at least trade up to 19 pence, which would fill the June gap to the downside that we had. At the moment, the best case scenario while we're above 15.5 is up to the resistance line projection from November as high as 22 pence. Obviously, we peaked out back in June around the 20.5 pence level. On to Ben's Creek, where one or two mutterings about the bearishness of my coverage yesterday. The big story here, I suppose, was the way that we had the break of the October uptrend line there around 63 pence earlier in the week. That took us down to the floor of this falling trend channel from March, around 38 pence. Current situation is that while we're below the 50-day, or rather the 200-day moving average at 51 pence, there is the risk not only of a retest of 38, but also the floor of that channel, which is pointing down towards the 30 pence area. That's seen as the worst case scenario at the moment. Otherwise, one would be looking to see that this market is currently oversold, the most oversold it's been basically since the shares came to market. So that may be taken as a positive by some, but a break of 38 could risk 30. Otherwise, it's back up to the 200-day moving average at 51 pence, then leading us back to the 60 pence area. So let's say 60, 51, 38 and 30, the levels there on Ben's Creek at the moment. On to Itaconix, which I've covered quite a lot, but alas not ahead of this latest spike that we had. This looks like a gap fill reversal. So we had the top of the gap there around 5.25 pence, also broken back above the 200-day moving average at 5.3 pence. And if we can get a weekly close above the 5 3/4 area, then we could be looking towards the top of that rising trend channel from November as high as 10p over the next 4 to 6 weeks. But the real sizzle here, the fill of that gap down, which can be a very strong signal. Moving along to a company which updated today, which I didn't cover actually for a change, Live Company, making it up for here with the charting view. Got an uptrend line there from back in December. That support line there around 5p, and above 5p there's a chance that Live Company could retest last month's resistance towards 8.5p and the 50-day moving average. We've bounced off the oversold area on the RSI scale, also bouncing off a rising 200-day line, which tends to be a reasonably reliable signal, but we've got that 5p level there as the support, notional support, ahead of a potential 8.5p technical target over the next 4 to 6 weeks. On to Codal, which I know is a very popular investor stock, private investor stock. Here we've got this falling line of support there, which the shares found last month, and we've had sort of little mini inverted head and shoulders as well. Broken the neckline there around 0.25, and above that, looking for the 200-day moving average area at 0.3. I think in current markets conditions, that would be a reasonable place to look, not too ambitious. If you are ambitious, though, you'd be looking for the top of that triangle that I've just drawn there from the turn of the year. That's heading towards 0.4p. So ideally, this is a stock which is in a range between 0.22, let's say, and 0.4. And we bounced off the floor of the range. Moving along to NonStandard, and here we've got a situation where it looks as though there's not much to go on here, but it looks as though we're at the floor of a rising trend channel, mildly rising trend channel there from December. And above the 1.5p area, looking for the shares to at least fill a few gaps there up towards the 50-day moving average, currently falling at 2.34. But as I'm saying with many of these stocks, that seems to be the most optimistic scenario that we could get over the near term, but only while we hold above 1.5p. Stock which has been difficult to handle for some over the recent past is Oracle Power. Here we're going into very oversold conditions. The last time we were as oversold as this was back, basically this time last year. You can see that RSI trace around the 12 out of 100 level. Gone down to that kind of area again this time, but although the price has gone lower, the RSI is slightly higher than it was when we were back in the oversold area before, which basically means we've got a bit of bullish divergence, long-dated bullish divergence. That could at least allow a dead cat bounce back towards 0.25 or 0.26p, even if the shares then fall away from there. But just looks like in the near term, we've got a bit of potential support there in the low 20s. Finishing off with Rambler, which is another bullish divergent situation. We don't have many signals, positive signals these days, but we have the lower low for June for June and July. They're around the 20p level. That compares to 21.5 for May, and that bullish divergence could be enough to give the shares enough momentum to get up to 26 or 27p, which would take them back to that November resistance line projection. That's it for me today, and if there are any positive developments over the course of today, we'll look at them over the weekend.